Sounds
Well,
good.
hi everybody that's on here. Tonight we're going to be talking about credit cards, and we have Lauren and Steven to talk to us about that. I'll read their bio real quick and then turn it over to them and let them get started. I do want to remind everybody too that if you don't want it reported, just have your camera turned off, and if you can fill the survey out that I put the link to after, that would be awesome. So Lauren and Stephen Keys were able to quit their full-time jobs permanently before either of them turned 30. They followed a simple financial roadmap that helped them reduce their expenses, make smart career moves, travel, and invest enough money to retire well before the traditional age of 65. Now they spend their time traveling and teaching others how to find their own path to financial independence. So I will turn it over to them and let them get started.
So we're gonna kind of zero in. As she mentioned, we run a blog that has a lot of finance content and travel stuff and lots of cool stuff on it. But we're gonna zero in today on one topic, which is credit cards. All right, so kind of tip of the iceberg on the world of personal finance, but pretty interesting topic. So yeah, I'm Steven, and the slide says I'm a huge nerd. So yeah, I mean, I'm wearing a Pokemon t-shirt right now. So if that's not enough evidence for you, then, I don't know. But hi.
I'm Lauren. I love desserts. Specifically, donuts are always going to be top of the list, but I'll take pretty much anything that's sugar-coated. And yeah, as it was mentioned already, we run a blog, triplelifestyle.com. We do a lot of personal finance, investing, financial independence, which you heard a little bit about last week, and all of our travel stuff. That's our van there. We took that, I guess 2 years ago now, to every national park in the U.S. Doesn't look like it, but you can fit a full-size bed in the back of that bad boy, and that's how we camped. So we still have it, and that's what we travel around in now.
This is what we awkwardly drive every day, no matter where we go, even to the grocery store. But
definitely lots of looks in as you're loading groceries on top of a bed, but it's fine.
So yeah, we're gonna get into this credit card stuff. Before we do that, I do want to mention to you, just for legal reasons, that we're bloggers. We talk about all this finance stuff, and we have a lot of experience with this stuff, but we are not professional financial advisors. So just know that going in. We're just trying to share some information with you. We're not giving professional financial advice. Basically, what we're going to go through is we're going to start out slow. All right, what is a credit card? Sorry if you get a little bit bored there. We're going to kind of build our way up and talk about credit cards a little bit more in detail, fun stuff like rewards you can earn from credit cards and things like that, pitfalls you want to avoid. And then at the end, we're going to get into something a little bit kind of crazy, which is how we actually personally made $20,000 profit by using our credit cards, which is a weird story. But anyway, yeah, that's what's up.
So first, let's go through what is a credit card. We'll start with an easy example, right? When you're at the store and you want to buy something, you can pay in a couple of different ways. The first way, cash, pretty easy. You take it out of your wallet, you hand it to the business. Pretty straightforward. The second way is to pay with a debit card. You hand them a card, they swipe it, and the money comes out of your checking account. Also pretty straightforward. When you use a credit card, you hand them the card, they swipe it, but the money comes from the bank. You actually don't pay for it until the bank bills you at the end of the month for the charges that you have made with that card. So when you pay with a credit card, the bank is the one paying the business, not you. So it's basically a loan in that way, right? And you've probably heard of other types of loans, car loans, mortgages on a house, student loans. They all have in common monthly payments, right? So when you get a bill for your credit card use at the end of each month, you have a couple different ways of paying. The first is to just pay the bill in full. The second is to pay less than what you've charged that month and let the balance roll over. That gives you a longer time to pay that off. So what happens then is, with all loans, there's an interest rate. With credit cards, that interest rate is really high. So when you roll over that balance, you incur that interest rate.
So the obvious question would be, what's better? Like, which way should you use it? How should you use a credit card if you're going to get one? Honestly, the goal is never pay that interest, because as Lauren mentioned, the interest rate on a credit card is pretty much the highest interest rate out of the common types of loans that you can take. So the bank wants you to kind of accrue a balance and then pay that interest and pay your stuff over time. But really the best way to use a credit card is to make sure you pay it off in full every single month. As long as you do that, if you pay that bill every single month in full, they charge you zero interest, nothing. But if you pay any less than the amount that you owe, they're going to actually usually charge you interest on the full balance, even the part that you paid. So it's not a great deal. So basically, the way to use it, any credit card ideally, is just never spend more money than you know that you can pay off immediately. So think about it this way. If you're going to use your debit card at the store and you wanted to say like, all right, do I have enough money to use my debit card? It's pretty easy to figure that out, right? You look at your checking account balance, and if the thing you're trying to buy is less than your checking account balance, then technically you can buy it, right? You have enough money. With a credit card, slightly more complicated than that, but really not that much more complicated. Here's your formula, right? Take your checking account balance, subtract what you already owe on your credit card, what you've already accrued this month, your credit card balance, and that you need to think of as the amount of money you actually have available for spending. That's the maximum amount you can possibly spend without really going into debt and not being able to pay your bill at the end of the month. So as long as you kind of abide by that rule always, you're never going to pay any interest. And I recommend keeping some extra cash in savings just to make sure you absolutely never go over. Emergencies happen, right? So the goal here is how to use a credit card. Don't pay interest. Pay your bill in full every single month. If you do that, you're good to go.
So this all sounds a little complicated, right? Why should you have the bank pay for your purchase for you and then pay them back immediately when you could just use your debit card or cash? Well, credit cards offer a lot of benefits. We're going to talk about a few of them, but really, you know, the credit cards actually can make it worth it to use them with some of these benefits. The first big benefit that you've probably heard a lot is cash back. You know, you see a commercial on TV that's like, get 2% on every purchase. What does that mean? I'll take you through it real quick. When you buy something with your credit card, the bank incentivizes you to make that purchase with the credit card by giving you a little rebate, 2% back, points for hotels, whatever, in the hopes that you spend a little bit more and end up paying that interest that we were talking about. Their whole motive is to incentivize you to keep spending and hopefully spend more than you can so that you pay that interest, right? That's their motivation. That's why they're marketing it this way. But if you follow the formula and never pay any interest, it's just free cash back. Really huge benefit, right? You're going to spend that money and you're going to get a little bit back. Sometimes they give you cash back in the form of points that you can then redeem for hotel rooms, airfare, etc. But when you really crunch the numbers, it turns out all the banks are really kind of giving you the same amount back. So cash is really the best option.
So here's an example of that. Like, if that sounds a little bit complicated, this is a real world example. So a common credit card that we use all the time is the Citi Double Cash card. And it basically boils down to 2% cash back on every purchase with this card. So as an example, if I go to the grocery store and I spend $50 on groceries, I get $50 times 0.02, 2%. I get $1 cash back. So my groceries really only cost me $49. But if I don't pay off that balance at the end of the month, I let it accrue, I'm going to pay way more than $50 in the long run because of that interest. All right. So that's only really true, the discount thing, the 2% cash back. It's only really true if you pay off your bill every single month. Now, dollar might not sound very exciting, like it's not worth it. But think about it this way. If my annual expenses, let's say all my bills added up are $25,000 for the year. Well, how much do I get cash back every year? That's $500. 2%, that's $500. That's real money. That's like $500 free dollars every single year just for being responsible with my credit card use and making sure I don't pay any interest. That is definitely worth it to get $500 every year for the rest of your life. All right. Number two benefit, so number one was cash back. Number two benefit of using a credit card also kind of makes it worth the hassle of going through this process is that it boosts up your credit score. So you've probably heard of a credit score, and maybe you don't know exactly what that is, but credit score, what you need to know is whenever you go apply for any kind of loan, like credit cards, but also other loans like later in life, let's say like a really important loan you would get would be your mortgage on your house, right? So a really big loan to buy a house with. The interest rate on that loan is going to be determined by your credit score. So if you have a really good credit score, they're going to charge you less interest on that loan. If you have a worse credit score, they're actually going to charge you more interest because you represent more of a risk to them. All right. So by using a credit card consistently over time and paying your bill on time every single month, especially paying it in full, your credit score goes up just a little bit every single month. And so this is something that happens over the course of years. So you want to get a credit card and use it consistently and pay it on time every month for many years. And then your credit score is going to end up really good. You'll have no problem getting like a mortgage or signing up for other credit cards if you want to in the future and stuff like that. So that's kind of benefit number 2. Do keep in mind though, if you ever make a late payment on your credit card, that actually damages your credit score a lot. So again, if you're going to get a credit card, make sure you're ready to pay it off every month and pay it on time every month.
The final thing that credit cards are really good for is a little bit of extra protection. So let's go back to that store example. If for some reason your wallet was stolen, someone took some cash out of it, they bought something at a store, that cash is gone, right? If someone steals your debit card, makes a purchase, that money's coming out of your checking account. Also not very good. But when someone steals your credit card and uses it at a store, the bank is the one paying for it. If you remember, that's what we talked about earlier. You can actually call up the bank and say, hey, I didn't make this charge. Don't bill me for it. And they'll actually take that off. They are the ones liable for that purchase, not you. So it's actually a really big benefit using a credit card on all of your purchases if you can, because any kind of fraud would get flagged and you wouldn't be responsible for it. But they also provide other protections. This varies from card to card, but one of the big ones that I see a lot of times is free insurance. So when you buy something like a phone with a credit card that has this free insurance benefit, if you drop that phone, that credit card will actually reimburse you for that phone and get you a new one. Other kind of ancillary benefits are extended return periods, extended warranties. That's all kind of in the fine print. You got to check it out yourself, but all credit cards offer that fraud protection, and that's really the biggest benefit here.
So your 3 benefits, right, are cash back, boosting your credit score, and then those extra benefits like fraud protection, stuff like that, right? Those are your 3 benefits. I want you to keep in mind, I know we're kind of beating a dead horse here, but it's like that important. Those benefits are only worth it if you are committed to paying off your bill in full every single month. Remember the reason why they're giving you those benefits, the bank is. They're giving you those benefits so you use the card, and they're hoping that you rack up a balance and pay huge amounts of interest, and they end up making a profit off of you. As long as you pay off your card every month, you don't pay any interest, all those benefits are basically free. So it's really worth it, but only if you're committed to that strategy and you don't mess up on it. All right, so keep that in mind. So what if you want to actually get started with this? Like, what are your options to do this, especially young? Most people watching this right now are under 18. So technically, your only real option if you're under 18 currently is to get added to one of your parents' credit cards as like an authorized user, okay? So if you do that, you'll get your own card, but the bill for the purchases you make on that are shared with your parent. And so it's your parents' responsibility to pay off that card every single month. Now, if your parents are really good with money, they pay off their bill every single month, right? That might be a really good idea for you because it might actually have an impact on your credit score. It might actually start to boost it even before you turn 18. Also gives you a little experience. You get those cash back benefits and those other benefits too. So might be worth it to do that. It's up to you. But the other option, as soon as you do turn 18, you can get your own credit card. So you can sign up for one of these rewards cards that we've been talking about that gives you like 2% cash back, like Citi Double Cash, for example, right? You go sign up for that when you're 18. But I will warn you that the better the card, the better the benefits that you sign up for, the harder they are to qualify for. So if you go and find a card that you like and you sign up for it when you're 18 years old, you might get rejected for that card immediately. Don't get discouraged by that. That's completely normal. Because when you're 18, you don't have much of a credit score, really. And so they tend to approve people more if they have a better credit score. So if you get rejected for your first card, there is one surefire thing you can do that guarantees you acceptance, which is to get a secured credit card, right? And the secured credit card, I'm not gonna lie to you, the secured credit card kind of sucks. Here's how the secured card works, right? It's guaranteed you'll get approved for it, but when you sign up for it, you have to give the bank some of your money. So the bank will say like, hey, congratulations, you're approved for the credit card. Give us $500. Okay, so you give them some money, and then, you know, a credit card's like a loan, right? Instead of loaning you the bank's own money, they literally loan you your money back when you're making purchases on the card. So they're loaning you your own money, and then when the monthly bill comes, you're paying it back to them again. Kind of dumb. But what that's doing is it's establishing a record that you can make those monthly payments on time, which boosts your credit score up. Once your credit score is high enough from having that secured credit card, you can usually convert that card into a regular credit card and get your deposit refunded. So you get that $500 or whatever it is back. Or you can sign up for a new credit card, cancel that one, and end up with that money back. I don't really recommend canceling your first credit card if you can possibly avoid it, because the older your credit cards are, the better your credit score is. Okay, so it actually pays off to keep your oldest credit cards. The other thing, the other option when you're young is if you're listening to this and you're saying, hey, this is a little bit scary. Like the bank is trying to do all this marketing stuff and give me all these benefits to convince me to spend too much money on a credit card so that I accrue all this interest and get into debt. And I'm supposed to be responsible enough to avoid that just to get these benefits. If you think to yourself, I don't know, like, I don't know if I'm gonna be able to commit to that. I don't know if I might slip up. That's okay. You got to be honest with yourself on that and make a personal decision. If you don't want to get a credit card yet because you don't feel ready for that kind of commitment, that's fine too. All right. You got to go into it with a commitment to doing it the right way. So we're going to pause here for a minute. I'm going to stop sharing this screen here and just actually look at y'all. And we'll just do a little Q&A. Yeah. So if you have questions, feel free to just speak up or type a question in the chat and we'll go from there.
I have a question.
Yeah, what's up?
Why is it good to have a good credit score?
All right, so basically, your credit score, the main thing, there's actually a lot of stuff that's randomly used for, but the main thing it's used for is determining your interest rate on loans that you might want to get in the future. And the biggest one of those that people get is a mortgage, which is a very large loan to buy a house. And so your interest rate on that, even if your interest rate is off by like 0.5% or 1%, that ends up being a huge sum of money on such a large purchase. So it's really important to have a good credit score when, for example, you go to get a mortgage for a house, because it can end up costing you a lot more in the long run if you get a higher interest rate on that loan. The other stuff your credit score is used for is like randomly, like your insurance company, like your car insurance, may actually check your credit score. And then if you have a higher credit score, sometimes they give you a little discount on your car insurance. And there's other random stuff too, like if you're applying to rent an apartment, for example, they might check your credit score for that and decide if they want to actually rent that apartment to you or somebody else. If somebody else has a higher credit score, it means like they might be more likely to make their rent payments on time and stuff like that, and they might prefer them over you. So it helps you in a lot of different ways.
The credit score is basically just a rough estimate of, are you good at using credit? When someone gives you a loan or loans you money, whether it's for a car or a house or from the bank in the form of a credit card, are you responsible enough to pay it back? And so you can kind of think of it as like a responsibility score.
So if you have a debit card and a credit card and say 1 month you don't actually use your credit card and you have nothing to pay off, would that affect your credit score at all if you didn't have anything to pay, so you didn't make a payment that month?
No, there's no like penalty for not using your
You
credit
don't
card.
have to use, like, so when you get a credit card, you have a credit limit. They allow you to spend a certain amount, which may or may not equal the amount of money you actually have in your account to pay, in your checking account to pay them back with. But you don't have to spend that money at any point. If you don't make any purchases in a month, there are plenty of times when we don't spend money in a month and it's fine.
Yeah, no penalty. If you let a card sit unused for like multiple years, sometimes they'll actually just send you a letter and say, yeah, we canceled your card. We don't really want you as a customer anymore because you never charge anything. But the thing I would stress though, like at a practical level with your question is, if you're using, let's say, your debit card 1 month instead of your credit card, you also should ask yourself, well, why exactly? So I'm not sure exactly what use case like you had in mind, but for me, when I think about it, like for us, we literally charge absolutely everything on our credit cards, and we don't use our debit card or cash for anything. And the reason is because we want to get the cash back on all the credit card purchases. The more that you put on the credit card, the more cash back you get. So you should just move all your expenses to credit cards if you can handle that responsibility and just pay them off every single month. So that's actually what we do, and we don't even use the debit card at all anymore. So I'm going to tell you a little bit about what we have done for basically the past 8 years. So I'm going to disclaimer this a little bit. Everything that we talked about before this point, if you were to go home and tell your parents all that stuff, they'd be very happy, I think, that you learned that stuff. All right. This second part is kind of controversial. Not everybody agrees with doing this, and we're not like recommending it or anything. We're just telling you a fun story about something that we did, and it might like spark some ideas and make you like kind of understand how credit cards work and how the psychology of them works a little bit better. Okay. The other thing I want to mention is everything here, we did not do this as soon as we turned 18 with our very first credit card, and we would never recommend that somebody do this. This is kind of an advanced strategy. We had credit cards for like 4 years before we did this. We started it when we were 22, and we did it for about, we're still doing it, but for about another 8 years after that or so. So it's called credit card churning. So here's how it works, all right? We talked about cash back, one of the major benefits of using a credit card responsibly. And it turns out that like cash back, which is an incentive to try to trick you to spend more money than you want to and get in debt, right? There's other incentives too. So actually there's a lot of credit cards out there that offer sign up bonuses. So as soon as you sign up, they're basically offering to give you like $500, like some significant amount of money right up front just for signing up. Okay, again, they're trying to trap you here. They're trying to entice you into signing up for a card in the hopes that you'll get in debt and pay really, really big interest. So the goal throughout all this is to avoid that. These cards that have these huge sign-up bonuses also have a couple other properties, all right? Most of them actually have an annual fee. So they charge you, let's say, like $100 a year just for having the card, whether you accrue interest or not. And they also usually have a minimum spending requirement. So they'll say, all right, you can sign up for our card and we'll give you $600 cash just for signing up. But you have to spend $2,000 in the first 3 months you have the card to get that bonus. All right. So again, they're trying to incentivize you to spend money. Now, if that's money you're going to spend anyway, like you're just going to pay your regular bills with that, well, it's kind of free money, right? It's a free $600. So why not do it? So the obvious strategy seems like it would be, right? Literally sign up for as many cards as you possibly can. But I'm sure y'all are smart. You're thinking about this. What could possibly go wrong? A lot could go wrong, right? You sign up for a whole bunch of credit cards. Some crazy stuff could happen, right? You could lose track of them. You could start having late payments. You could accrue debt that you didn't intend to accrue and have a bunch of interest. Maybe it could damage your credit score. Actually, it turns out signing up for too many loans could be dangerous for your credit score. There's a lot of potential negatives and scary stuff about this. But we did it anyway. So for the last 8 years or so, we, between the two of us, signed up for 41 different credit cards, which is not a normal number of credit cards to sign up for.
Most people have like 2.
Yeah. And because of those sign-up bonuses, we actually ended up earning over $20,000 cash by doing that. So it was very, very profitable for us. And
I wanted to say one thing too.
Go for it.
Someone had asked, why care about a credit score? What's the benefit of having a credit score? These kinds of cards that offer these big sign-up bonuses are usually more geared toward people who have excellent credit, and getting into that higher credit score range qualifies you to do this kind of thing. Because again, they think you're more responsible and that you're not just signing up to get the bonus.
Which we were.
Yeah.
So let's take a step back here, right? Because honestly, if something sounds too good to be true, it should trigger like alarms and red flags in your head.
It usually is, right?
So hopefully like those bells are going off in your head and you're like, oh, I feel pretty skeptical. These sketchy people are telling me this stuff. All right. So let's think it through for a second. The banks made no interest from us because we paid our bills on time every single month. We never, ever missed one. We paid nothing. And we took $20,000 from them. So why? Why do they do that? Why did they let us do that? Well, the answer is they got to make the rules the same for everybody across the board, right? And if they offer these bonuses up, they know statistically that most people are not necessarily responsible enough or haven't thought it through quite enough to not get in that debt trap. And they're going to end up paying really, really high interest rates. And they're going to end up actually more than making up those sign-up bonuses in the form of interest and other fees, like the annual fee. If you let the card sit there for many years, you're paying that annual fee, $100 a year. That can add up. But more importantly, the interest of getting in debt. All right. So the credit card companies aren't doing this out of the goodness of their heart. They're doing it because they're hoping you're going to kind of mess up the strategy and end up not profiting, which does happen to a lot of people. So you have to be really careful. So let's talk about the risks, right? What could happen? What bad stuff could happen if you tried this out? Well, if you, let's say, had too many cards to juggle and you had a late payment, that's going to hurt your credit score, right? It's also going to trigger interest and stuff like that. So you need to be really organized if you were ever going to try a strategy like this. So like we just keep a Google Doc full of all the credit cards that we've ever signed up for, what dates that they need to be canceled by to avoid the annual fees, which we'll talk about in a minute.
Make calendar reminders on your phone.
Yeah, exactly. The other risks, right, are getting far into debt and paying lots and lots of interest. Overconsumption, in other words, saying, all right, well, every time I sign up for one of these cards, I get $600 for free. I'm going to sign up for one. Oh, wait, I have to spend $2,000 to get that $600. I'm going to go spend $2,000 I wasn't going to spend anyway. If you're doing that, you're losing the game. You got to just put your regular normal expenses, the kind of stuff that you would have bought anyway on these cards, and just do it at whatever rate that turns out to be. You don't want to go overboard and then buy stuff that you weren't planning on buying anyway. That's going to end up costing you more money than it makes you. So you got to be disciplined on that. And then credit score damage. The other thing is, a lot of people warn that if you sign up for too many credit cards in too short of a period of time, it can actually hurt your credit score. And that is a risk. Now, I will mention that we signed up for these 41 cards. We kind of expected our credit score actually to take a dip because of that.
We were planning on that.
And if you read our blog, you'll kind of see we have like a whole alternative view of what life should look like. So before, like we talked about how important it is to have a good credit score because your mortgage interest depends on your credit score, right?
And car loans.
And your car loans.
Mm-hmm.
We have never taken a car loan, and we bought our house in cash. We didn't even take a mortgage for it. And we knew that we were going to do those things. So we actually never really cared if our credit score dropped. Most people that doesn't really apply to. So this can be kind of a scary strategy for someone who doesn't feel that same way, that they're going to like pay cash for their car, pay cash for their house, all that stuff. So you got to think about that. But I will say, after doing this and making our payments on time every single time for all those cards, our credit scores actually consistently went up. They're like over 815, I want to say now.
Yeah, that screenshot in that slide previously was my credit score a few months ago.
Yeah, and so 850 is actually the maximum credit score you can have. So to give you context, like it's close to literally the best credit score you can have. So for us, it actually ended up not damaging our credit score too much. However, they changed the rules on how credit scores work and stuff all the time. So there's really no way to predict how that might go. We only went into it and took that risk because we knew that we didn't really care that much about our credit score.
We were planning to not need our credit score in life in general.
And that's sort of unusual. So you want to keep that in mind. I did forget to mention, by the way, that in terms of being organized, I'll mention that. We talked about annual fees. These cards charge annual fees. So how do you avoid paying those annual fees? Let's say you get a $600 sign-up bonus for one of these cards, but they charge $100 a year to have the card. Well, what you do is you sign up for the card, and then you get your bonus, and then you cancel the card before 1 year is up, so you never have to pay that annual fee. That's another part of this whole credit score damage thing, is that canceling too many credit cards supposedly can have a negative impact on your credit score.
Well, we talked earlier about that history, and if you only have a card for less than 12 months and you cancel it, that is truncating that history. It's not a long period of time, it's a very short period of time in the scheme of your total credit history of your life.
So that's a risk that we took. It ended up paying off, and it actually didn't hurt our credit score, but we were prepared for it to if necessary. We also have an article on our blog all about that strategy and about the regular stuff too.
Yeah, we have a very complete guide for how to just be a good credit card user, very traditional, regular path. If you just want to get the free benefits and never have to worry about the crazy stuff, we have a guide for that, but also an entire manifesto of what we did and how we did it for making that 20 grand of just credit card sign-up bonuses.
If you feel like you could use a source to get like good financial tips and information like this, just take a second, pull out your phone, just like follow us on one of your favorite social media platforms or something like that. Or there's an email sign up at the very bottom of our website. You can just go to the website and scroll down to the bottom and sign up for emails. Whatever you prefer, it doesn't matter to us. But it's kind of good sometimes to have somebody whispering in your ear every couple of days through like social media or whatever and giving you like finance tips and stuff like that. So we talk a lot about other stuff than credit cards. We talk about investing, early retirement, saving money, reducing your expenses, and travel too. So if you like travel, you might enjoy our site. So we're gonna do a little more Q&A here. That's really all we have planned. So I hope you have lots of questions for us, and we'll stay as long as you want. I see a question here in the chat. So someone's asking us, what is a good credit card to use, like a specific card? So I would say that the best card I can recommend for like someone starting out, if you can qualify for it, is the Citi Double Cash card. It really is just the simplest. It's going to give you that 2% cash back on everything you buy, and it's in the form of cash. You don't have to redeem it for like hotels and airlines and stuff like that. They literally just give you cash money. And so that's a really good card. But like I mentioned before, we were talking about you may not qualify for the first card you apply for when you turn 18. So if you tried for that card and you didn't get it, you would want to just look for a secured card. And if you can find a secured card, they kind of change up all the time, and there's lots of banks that offer them. If you can find a secured card that gives you any kind of cash back, even if it's just 1% cash back, go for that. Otherwise, you're going to just have to sign up for one that probably doesn't have too many benefits and just ride it out for a few months while you build your credit score up, and then try again for something like the Citi Double Cash.
There are also really like basic beginner level cards. Like my first card wasn't even a rewards card in college because I had no credit history. And like, I think my credit limit was like $200. And so it was like, usually they're thousands of dollars. So like they just were like, this is all you get. And it was very basic. I think it was a Citi card, but not any kind of cash back. But if you are a student, there are a lot of student geared credit cards, like if you're going to college, where they know that you are a student, that you probably don't have as much credit history. And so that is an option before you try to apply for these cards with all these fancy cash back benefits or sign up bonus benefits. You could go the route of a really, really basic credit card, and any that are geared toward a student might be more likely to accept you even if you don't have that long, good credit history before trying a secure card. I would just kind of look around and see what's available, because these kinds of offers change and the terms change all the time. So,
is there a disadvantage? Are there any disadvantages of using that student card?
So usually those student cards, the ones that are geared toward people with like not too much credit history, the only disadvantage to them normally is that the benefits are less.
mm-hmm.
So they may actually not offer you much of any benefit. All credit cards offer you that fraud protection. Like if somebody steals your card, you're not going to be liable for it. So that's a benefit across the board with credit cards. But in terms of like cash back, instead of 2%, those student cards, they might offer you 1%, or they might offer you nothing.
Yeah. My card offered literally nothing. My first card, absolutely nothing. But it built my history and allowed me to qualify for those better cashback cards a few months down the road.
And so sometimes going for one of those lower tier cards, like a student card with no benefits on it, it's a trade-off, because like you'd like to apply for one that's better, like the Citi Double Cash or something like that. But it's better to get one that you can qualify for that's not a secured card, so you don't have to give them a deposit, right?
Yeah.
And loan yourself your own money. So if you can apply and get one of those student cards, it may be worth it, even if it doesn't have benefits, just to build your credit for a little while and not have to go the route of the secured card. I see another question in the chat here. It says, if you never get a credit card, will that negatively affect you? And the answer there is yes and no. If you never get a credit card because you're afraid that, you may not be able to do all the things that we said and like be really careful and really responsible with it, and you may get deep into debt, well, that's not going to negatively affect you at all. That's a positive effect. That's you making a responsible choice because you know that credit cards aren't right for you, right? But in terms of just like the mathematical stuff, never getting a credit card kind of hurts you in the sense that you won't get those benefits we talked about, and you won't build your credit score through that avenue. Now, there are other ways to build your credit score. Any kind of loan that you get actually builds your credit score. So there's plenty of people who build their credit score without credit cards too. So you can definitely live life with having never gotten a credit card. Name of the blog. Somebody asked that on the chat there. It's Trip of a Lifestyle. Tripofalifestyle.com is the blog.
And we've got, I'll just do a little quick plug. We've got a whole financial roadmap on there, by the way, that kind of takes you from graduating high school to being able to quit your job forever if you want to, within like 10 years. It's like 6 steps. It's pretty straightforward and can be done simply if you get started early. It's a lot easier. So that's one of the things that we're really excited about, kind of taken from our own life path of being able to quit our jobs at 29. So just something I wanted to throw out there for you.
We're always excited to talk to people that are on the younger side, because honestly, with all things money, the earlier you start in the life, the further ahead you're going to get and the quicker you can get there. So if you really like put your nose to the grindstone and like do all the right money stuff when you're in your teens and your 20s, I mean, you're pretty much set for life. So a lot of people don't get interested in this finance stuff until they're 30, 40, sometimes even 50 years old. And it makes it really hard to get where you need to be. So you can have life on easy street if you really start early, and you have a little bit of luck on your side along the way.
I'm curious, what did you guys do before you retired? Like what were your careers?
I taught physics. I was a high school teacher for 2 years, and then I did private tutoring after that.
I've been in marketing, working for various firms, doing for a finance firm, for a design company, for a web marketing company. So I've been doing all kinds of journalism / marketing stuff since college. We also have a photography business.
Yep.
That's
Little
been
side
like
hustle.
one of our side hustles. Yeah, we have we've done a lot of crazy things, including credit card churning, but photography is probably the more like legitimate one to talk about with people. Feel free to reach out. You can DM us if you have any other questions on social media, or send us an email. We're pretty responsive. We're excited for you guys because we know how powerful it was for us to like do this stuff right out of college and right out of high school to like hit the ground running. We both had credit cards all through college, and that was like a big help in building our scores and qualifying for those better cards later in life to get $20,000 for free. So yeah, thanks for having us, and feel free to reach out anytime.